In investing, there's an obsession with gross returns. We analyze fact sheets, we watch graphs go up, but we ignore the number that matters the most, your net return. That's the money that actually reaches you after tax. If you are a high income earner, you have a leak in your bucket. That leak is your marginal tax rate. And if you're in the top bracket, close to half of your interest leaks out before it ever compounds. Today, I want to show you how to plug that leak. It's not about picking a fund manager, it's about using the right legal structure. It's called a life wrapped investment or an endowment. Think of it as a tax containment unit for your capital. Most people invest in their personal name. That means you are the taxpayer. All interest, rental income, and gains are added to your personal tax return. With a life wrapper, the structure changes. You invest through an insurer. They invest the capital on your behalf. Your money sits inside what's called an individual policyholder fund. Inside this fund, the tax rules are different. Interest and rental income are taxed at a fixed rate of 30%. Dividends are taxed as normally where the company that pays it over taxes it before paying it out. So there's no dividend tax advantage. But the insurer settles all tax before reinvestment. The real advantage comes from capital gains. If you invest personally and you're in the top tax bracket, your effective capital gains tax rate is 45% times the 45% inclusion rate, which comes to 18%. Inside a life wrapper, that effective rate drops to 12%. That's a one-third reduction in tax on your growth. And when money is paid out, or any money that you received is already taxed inside the fund, so it would not affect your personal taxes in any way. Now, let's look at offshore investing. Most people buy international exposure using rands via a local feeder fund. This creates a hidden problem, currency fluctuations. Imagine you own an Apple share. The share price does not move, but the rand weakens from 15 rand to 20 rand against the dollar. So your statement will show a profit in rand, and if you sell those units, SARS will treat that currency movement as a capital gain. So you would pay tax on the asset gaining value and you would pay tax on the rand weakening. So you are effectively paying tax on inflation. With the international life wrapper, the structure changes again. You invest directly in hard currency, dollars, pounds, euros, whatever you want. SARS measures your gain in the asset's base currency. They look at only the movement in the previous example, the Apple share. They would not tax you on the rand weakening. You avoid the double tax effect of asset growth and currency movement. There is a second offshore risk some people miss, foreign probate. If you own offshore assets in your own name, you create a foreign estate. When you die, these assets can be frozen and an executor must apply for probate in the foreign country. That means foreign lawyers, foreign courts, and can cause long delays. With a life wrapper, the insurer owns the assets. There's no foreign estate, no foreign probate. You nominate a beneficiary and the payout can happen either locally or in a different country. It's quick and efficient. In any year, you may not invest more than 120% of the highest contribution made in the previous 2 years. If you exceed that limit, the 5-year restriction period resets. The price of this tax benefit is liquidity. When the policy starts, a 5-year restriction period applies. During these 5 years, you are limited to one loan and one disinvestment. Withdrawals are capped at your original capital plus 5% compound growth per year. That's the trade. You have reduced liquidity in exchange for tax efficiency. There's a part many people misunderstand. After 5 years, the restriction falls away. You can withdraw at any time, but you don't have to. There's no forced maturity or automatic cash out. Your money can remain inside the wrapper, still invested, still tax efficient. You keep the structure, you keep the benefits, and you can decide when you want to access the capital. A life wrapper also allows a beneficiary nomination. This bypasses your executor and it reduces executor fees. Executor fees can be over 4% inclusive of VAT. So on a 5 million rand investment, that's more than 200,000 rand saved. A life wrapped investment is a long-term structuring tool. It protects interest income and it reduces your capital gains to 12%. It shields offshore assets from currency tax and it avoids foreign probate. If you can accept lower liquidity, the numbers work. This is not a loophole, it's not clever tax avoidance, it's simply efficient structuring. It's important to note that this will not be the right way for everybody. So it's important to speak to your financial planner before you make any decisions about your money. Thanks.